Is Teladoc stock or TDOC stock in a terminal decline? The stock is down around 20% following their second quarter 2022 earnings update, which in all honesty wasn't great. In the quarter, they reported yet another multi-billion-dollar goodwill impairment, a $3 billion goodwill impairment from previous acquisitions like Livongo and InTouch Health, because here it is, they acquired a bunch of businesses to make the Teladoc experience a holistic experience, and they overpaid. And part of the reason why the stock declined is because they're talking about, yeah, our guidance is okay. They're saying the company is maintaining its previously issued revenue and adjusted EBITDA outlook. However, based on current trends in the market, management now expects results to be toward the lower end of those ranges. So they were talking about 18 to 23% growth. They're saying it's probably going to be towards the lower end of it, which makes sense because they're guiding for the next quarter closer to 15 to 19%. Honestly, I've looked at management play the guidance game here so many times where they're like, oh yeah, we're going to do this and we don't hit expectation. We're going to do this and we miss expectation. And it's like, dude, how many times do you need to run into a wall to figure out maybe you shouldn't be playing this game? Like, just don't do guidance going forward. It's that simple. There's so many, there's so many companies that don't do it. And Berkshire Hathaway's done fairly well. They don't do guidance. You don't see Warren Buffett sweating, oh, this is what our numbers could be. He's focused on shareholder value. So it's just a function that management is playing a different game. And this is part of a broader comment that I'm going to be getting to about management towards the end of this video. But, I want to focus on shareholder value, not playing the numbers game, because that can lead to sort of like, oh, we got to make our numbers this quarter. Clearly, they're not in that behavior because they keep missing numbers each quarter in terms of what they're, projecting effectively. Like, oh, yeah, we're going to do this. Oh, yeah, it might not work out so well. So I look at this guidance game as pretty silly. I mean, it's somewhat helpful to shareholders, but if you consistently, sort of whiff on it, like they've done, I'd argue, sort of saying, hey, this is our outlook, oh, it's not going to be so good, then really it just kills management credibility, which is much worse. Now, management did talk about how they are seeing deals continue to progress, but at a slower pace. So that's part of the reason why they're talking about the lower end of this outlook. They believe this is in partly due to competitive noise as the market transitions from standalone point solutions to integrated whole person virtual care. So effectively saying competition. There are some competitors out there, and that's not the only time they talked about it. They also talked about it with their direct-to-consumer business, BetterHelp, where they saw, they're seeing smaller private competitors pursuing what we believe are low or no return customer acquisition strategies to establish market share. So this does not bode well. This means that as long as, effectively competitor telehealth solutions have the money, have the bankroll to acquire customers, even if they're overpaying for what these customers are worth, you know what? Because they have the bankroll to do it, they want to say, hey, we have a 5% market share of, let's say, the telehealth, mental health market. And that is resulting in arguably worse financial conditions for Teladoc, because they're saying, yeah, these competitors are bidding up the cost of acquiring customers. And this type of situation, this happens to all industries. If you have competitors that behave irrationally because they got a lot of capital and they're looking to grow, that can result in subpar returns for some time. So that is something to watch and be mindful of with Teladoc stock and what's going on there. That said, I mean, they are still putting up some very, very reasonable core metrics. For example, their US paid members was up around 9 million. You're seeing, very reasonable, around 10% growth in their unique chronic care members. Their average US revenue per member is growing. So looking at this business, it's not like it's not growing. It's still growing. They're still getting millions of visits. Visits are continuing to grow, and utilization of Teladoc's services, their telehealth services, continue to increase. So members find it valuable. And I'd argue management is sort of leaning in to their value proposition. They talk about how they're in the early part of the adoption curve for virtual primary care, and we continue to see indications of strong demand. 2/3 of engaged members had not seen a doctor in the last 2 years prior to Primary 360, one of their telehealth solutions, and nearly 1/3 say that they would not have seen a doctor at all. This is a big deal. The reason why, being able to say, hey, we're helping members see a primary care doctor where they wouldn't have seen it otherwise, is this can oftentimes prevent much worse health conditions for a patient, or if you're able to, sort of nip a problem in the bud, then you can prevent it from becoming much worse in the future. The classic example is it's much easier to treat earlier stage cancers than later stage cancers. Later stage cancers, have a much higher, mortality rate. And so, looking at this is, they're saying, yeah, people are engaging with this. They wouldn't have otherwise, maybe because of the inconvenience of seeing a doctor or trying to schedule it with, their work schedule. And so this is creating value. They talk about how patients are reporting high satisfaction with their telehealth solutions, and they're leaning into their value proposition, as I already mentioned, constantly trying to figure out ways to enhance it from the customer perspective, leaning into solutions like in-home lab testing, now available at no additional cost to Primary 360 members across the US, and free same-day delivery of prescription medications. Same-day free delivery. Prescription medications is being rolled out in the second half of this year. That's potentially quite a big deal because, effectively prescription compliance, where a lot of patients aren't even able, they don't pick it up because of the inconvenience of like, oh, I don't want to have to go out of my way to the pharmacy or the cost of it. That oftentimes makes things worse for the patient because they don't actually comply. So here it is. If you're able to remove the frictions from the system, it is possible that you do get healthier patients over time, which actually potentially lowers cost over time for, let's say, the healthcare insurers or healthcare providers. So the question is, what happens to Teladoc stock from here? If you're struggling with this investment environment, consider unrivaledinvesting.com for new ideas and a community of like-minded investors. And so look, Teladoc stock has gotten crushed. The stock's down something like 90%. The valuation is arguably down even more. Now, valuation is always, I don't want to anchor to it because arguably what it got to, which was around, 40, 50, 60 times sales, was just cuckoo bananas. I mean, it was just ridiculous. And look, that's what investors were willing to pay for it. And that's the reason why, in my opinion, it's so important to size up what's the valuation and sort of include that in a valuation framework, because that could be a huge headwind for future returns and it could be a big tailwind for future returns. You need to be able to sort of think about it when you're looking at investments. And full disclosure, I do own a teeny tiny position in Teladoc that I bought slightly above current prices. Originally, I actually got exposure to Teladoc because I bought Livongo, and that worked out very well. I actually did a video on Livongo quite some time ago that you can check out here on YouTube. It was one of my earlier videos, one of my first videos, I believe. And, Livongo shareholders got Teladoc stock for the deal for the most part. And at that point, that's where I actually sold most of my Teladoc shares. So that actually worked out really well. And since then, I've sort of been watching this saying, yeah, I do agree that telehealth is the future, but what's the right price? When do I want to potentially buy? Because here it is, Teladoc is, I'd argue, the leading player, and they're leaning into their value proposition over time, and their valuation has gotten crushed. So I am interested, and they are still growing 18% in the most recent quarter. It's not like it's flat growth. They're still expanding the market now, and they're still, they're not at the profitability I want to see, but on an adjusted EBITDA basis, that means on a free cash flow basis, they should be generating free cash flow. Now, it might be generating a lot of dilution in the process. There might be a lot of stock-based compensation. So effectively, your piece of the pie gets smaller each year, but the free cash flow is there. So that does sort of lower the risks of this situation. But they do have a positive adjusted EBITDA. I want to see more of that. I want to see real EBITDA. I want to see real free cash flow. And looking at their business, if they're able to get an entrenched position where effectively the partners that they work, the systems that they work with say, hey, this is a valuable solution. We are not switching. We are very happy with their holistic telehealth solutions. If they're able to do that, I could see Teladoc getting much, much higher margins versus their current unprofitable level, partly because 40% of their revenue right now is effectively getting respent in the form of advertising, marketing, and sales. So if you're able to effectively say, hey, customers, do you like our service? And if the customers go, yeah, we love it, then that money on advertising, marketing, and sales could that go down significantly in the future because they don't need to spend that much, or they capture that market? And so this is still fairly early days where they're continuing to take market share and they're continuing to expand. So I understand why they're investing in that, but that is a component that I think about where this business at scale, as it gets bigger, could leverage those expenses, where if there is true customer stickiness, you could see much greater real profitability in the future. And so that is a data point that I think about. Now, there is a very real risk with this business, which is that they do talk about, they talk about clean balance sheet. I don't like seeing a net debt balance sheet like they have, unless you have unless you have real strong free cash flow. And I look at this business, they've got 1.53 billion in debt, primarily convertible bonds, and around 900 million in cash and short-term investments. So that means around 600 million in net debt that's going to need to get paid between 2025 and 2027. These are primarily busted converts. So that means these converts were issued when Teladoc stock was much, much higher. And so there was this assumption, as long as Teladoc stock keeps going higher, then I don't mind converting these bonds into stock. But as long as the share price is where it is, even if, let's say, the share price doubles, Teladoc convertible bondholders are going to say, hey, it's not worth it for me to convert into stock. I want cash. And in that situation, Teladoc is going to need to step up and say, hey, here's $600 million that at this point right now, they don't have the cash for. So that is now, could they refinance that debt by 2025, 2027? Really, it's closer to 2027 that you have to really start worrying about, because they have the cash to cover their 2025 obligations. So really, it's a question of, will the credit market support companies that are like Teladoc right now? I'd argue right now, if they wanted to refinance, that would be much, much harder. It wouldn't happen. That would be my bet based on, my assessment of the credit markets right now. Second is, this is a real testament that they need to. This is a real, focus on turning into real free cash flow. Now, they might still be able to generate that 600 million over the next few years effectively by dilution, by having really high stock-based compensation. If they do 200 million of stock-based compensation and effectively run the rest of the business at break even, that could get them above that $600 million threshold to refinance or repay these obligations. So that, they could eke it out, squeeze it that way. I'd prefer they do it in the real way, which is, hey, this business is generating real free cash flow. It's not just from diluting existing shareholders. So that is a legitimate risk that investors need to be mindful of. Now, I'd say the last key component that's preventing me from actually buying in size, and the reason why I bought a little but not really scaled up, is because they paid $18 billion for Livongo, and they currently have a $5 billion market cap. So this means management really, really overpaid. I thought that they were overpaying when they bought Livongo from me. I was like, wow, this is great. This price for Livongo is cookie dukes. But I was like, hey, I'm not going to turn it down. It's, if I cash in the Teladoc stock and bring it to the bank teller, it's not like the bank teller's like, they overpaid you for these Livongo shares. We're not going to, this cash is no good here. That's not how this works. And so at the time, I thought, yeah, management actually doesn't understand value creation because they're way overpaying. And so that's the challenge, is, can you trust management? And arguably capital allocation is one of the most important jobs that management has to do. And this is a big failing grade. When you spend nearly $20 billion on an acquisition, and the current total enterprise value of the business that includes the acquisition is now $6 billion, you really made you really whiffed. It's a failing grade, in my opinion. Especially when you have around 10 billion goodwill impairments this year. Now, it's not all bad. Management did acquire BetterHelp for around 5 million back in 2015, before telehealth was getting super popular. And since then, BetterHelp has grown to around 700 million in revenue. So that clearly was a big win. So I can't say management's just completely inept or incompetent, but I will say, where it matters on scale, that Livongo purchase, they just overdid it. So maybe, they could advise, they could do, they could help run the business, but there's a big difference between operations, let's say, and capital allocation. And capital allocation is where most of the value creation is, in my opinion, for a business like this, especially if you're looking to do a lot of acquisitions. And so if you have a history where you really whiff on it, that is quite problematic. And so I think you do need to see new management in place before I get really excited about the future for Teladoc. Now, as I mentioned, I already do own Teladoc stock. It's around $5-6 billion valuation market cap. The company historically did grow quite quickly, partly because of acquisitions. This year, they're guiding to around, I think, 2.4, 2.5 billion. So I'm including the, 2.4. Maybe it goes below this. So maybe I'm not being conservative enough. I'm saying 18 to 22%. I do think longer term, they could be able to get high teens margins, maybe even around 20% margin, given that they have really, if you look at their gross margins, look at the underlying cost of this business, it's not like it's a high, it's not like it's a low gross margin business. I believe at scale, if they have real customer stickiness, they're able to get some leverage and some real profitability. They also do have some international operations. So that's part of the reason why I tweaked down the tax rate down to around 15%, what I'm assuming. But look, this company's trading at 2 times forward sales. If you assume they're able to get to these margins, it's effectively trading at a teens earnings multiple. They're nowhere near that now. They're significantly unprofitable now. Now, what's the growth rate in the years ahead? Once again, I'm assuming a low teens rate on the low side, high teens rate on the high side. Keep in mind, this is what I think, investors are potentially playing for. So I always like to pencil out, well, what am I playing for as an investor? Could it completely whiff? Could, the stock price go way below this? Absolutely. If their fundamentals stink and if, I way overestimate what management can deliver on, absolutely. Now, of course, stock price go way higher also based on, once again, execution and fundamentals. And so looking at this, I think there's a reasonable range of growth rates. Maybe I'm being too aggressive here. Maybe it's really, 10 to 15% in the years ahead, assuming a 15 to 20 times earnings multiple 5 years out, and you're effectively penciling out 50% plus upside to 200% plus upside. That's part of the reason why I own the stock right now, but I do want to see some key changes, like a management that's more attuned to value creation for shareholders, that really understands you need to pay the right value for certain things. And there are some sort of data points that might happen. You've seen some of their recent hires. And so we'll see. I look at this, there's a reason why I own a teaser position in Teladoc. So I'm calling that out. It's stock that I'm very excited by the prospects of telehealth. And I hope that it continues to grow because, if you're able to remove some of the friction, if you're able to remove some of the costs from the healthcare system, that could be a net positive, not only for the US, but for the world, especially if they're able to roll this out internationally, where you can have, let's say, the best doctors in one region treating, patients all over the world. That is an amazing possibility. So I think there's a lot of potential here. It's just about execution and making sure that you have the right management on board. That's and also seeing that the business gets to scale with that profitability. So I'm watching it here. I'm interested in buying more if I start seeing some of these developments, like better execution, better, if I see management stop talking about guidance where they just keep bonk yourself on the head. Stop doing it, man. Just focus on the business as opposed to saying what you think their guidance is going to be. I think that would make a lot more sense. Personally, a lot of investors will disagree with me on that. If you have an opinion on Teladoc stock, I'd absolutely love to hear it. Please leave a comment below. If you enjoyed this video, please make a point of hitting that thumbs up, hit that like button, and thank you so much for watching Unrivaled Investing.